Okay, let's unpack this. We are diving into a commodity that, well, it's been the subject of some really eye-watering, almost unbelievable price forecasts.
Hmm.
For decades, silver has sort of played the quiet, overlooked cousin to gold, but recently it has gone completely parabolic.
It really has.
And it's generating these price targets that are so extreme, they sound less like market analysis and more like, I don't know, financial science fiction.
It's certainly impossible to ignore now. The volatility we've seen is, it's historic.
Yeah.
And let's ground that with some hard numbers. As of January 14th, 2026, silver prices have spiked to around $90 per ounce.
$90.
And crucially, that came after an absolutely massive 148% surge through all of 2025,
Wow.
which put silver firmly at the top of the commodity charts. I mean, it dwarfed gold's own respectable but much smaller 60% gain.
148% gain in a year is just astounding. Suddenly this, boring metal is everywhere.
But
So our mission today is to dive deep into the specific quantitative models that are forecasting silver could climb potentially all the way to $300 an ounce.
300.
Yeah. We need to understand the structural imbalances, the surprising history of these ratios, and the intense demand driving this really extraordinary prediction.
And we are looking at the foundational data here, the quote, hard mechanics of the market. But given the extreme nature of these numbers, we have to start with a disclaimer.
Of course.
We are dealing with extreme volatility. This deep dive is purely factual market data and historical analysis for educational purposes only.
Right.
Precious metals prices are highly volatile, and this is absolutely not financial advice. You have to consult qualified financial professionals.
Duly noted.
Yeah.
But let's get to the core of it, because when I see a headline like $300 silver, my first question is, is this just clickbait? Or is there real substance there?
Right.
Where do we even start with a number that high?
We have to start with the mathematical basis, and that begins with the historical relationship between the two metals, the gold-silver ratio, or the GSR.
Okay, for anyone unfamiliar, the GSR just measures how many ounces of silver you need to buy 1 ounce of gold. So where's that sitting right now?
Right now, the ratio is near 50 to 1.
51.
So 50 ounces of silver to buy 1 ounce of gold. Now, the model-based forecast for $300 silver, it absolutely hinges on that ratio normalizing dramatically.
Normalizing back to what?
Back to what's called the historical monetary equilibrium, which is 15 to 1.
Wait, hold on. 50 to 1 down to 15 to 1 that's a monumental shift. Why is 15 the magic number?
Well, that 15 to 1 ratio, it dates back to pre-1900s bimetallic standards where silver was often pegged against gold at that value.
Okay, so it's a historical precedent.
It's seen as a kind of historical natural equilibrium.
Yeah.
And the argument is that whenever there's monetary stress or
When
debasement,
people lose faith in paper currency.
exactly, the metals return to that more traditional compressed relationship.
So if we accept that theory for a moment, how does the math actually get us to $300?
It's actually a pretty simple calculation. It's based on a future gold price.
Okay.
The models assume that gold, which has also been surging, continues to climb and hits, say, $4,600 an ounce.
4,600. Got it.
So if gold hits $4,600 and the ratio returns to 15 to 1, then you just divide 4,600 by 15.
And that gets you to 300.
That is the core equation driving these massive headlines.
I see the math, but I'm still skeptical. Has the market ever actually supported a ratio that tight in our modern era?
It has. History shows this isn't unprecedented during periods of market stress.
Like when?
Think back to the famous Hunt Brothers squeeze in 1980. The ratio plunged below 20 to 1.
Right.
And that pushed silver above $50. If you adjust that $50 price for inflation to today, you're already looking at a price north of $170.
That's a great point.
And even more recently, during the 2011 rally, the ratio tightened significantly. It hit 30 to 1 at the peak. So the precedents for this kind of compression, they exist.
Okay, that covers the market precedent. But there's a fundamental disconnect we need to talk about, and this is where it gets really interesting for me.
Mm-hmm.
Let's look at the actual production ratio. What are miners digging out of the ground?
This is probably the most fascinating structural flaw in the whole market.
Right.
While the market ratio is 50 to 1, global mining yields roughly 8 to 10 ounces of silver for every single ounce of gold.
So a ratio of like 9 to 1.
Exactly. The real-world production ratio is an extremely tight 1 to 8 or 1 to 10.
So nature's producing them at a 9 to 1 ratio, but the paper market values them at 50 to 1.
Yeah.
That is a massive, persistent gap. Why does that exist?
Well, the gap signals a really profound imbalance between the paper trading market, where silver is often just a leveraged speculative tool, and the actual physical availability of the metal. The argument is that this imbalance has to eventually collapse back toward that production reality, especially as above-ground stocks, the physical inventory keeps dwindling.
And that leads us perfectly into the fundamentals.
Yeah.
Because the math only matters if the physical reality backs it up.
Right.
Is the market actually feeling a squeeze right now?
Absolutely. The market isn't just unbalanced, it's chronically deficient.
How deficient?
The Silver Institute is reporting annual deficits that have surpassed 200 million ounces every single year since 2021.
Wow, 200 million ounces.
This isn't a small fluctuation, it's a systemic failure of supply to meet demand.
And a deficit that big, for that many years, can only mean one thing for physical stocks.
It means the above-ground inventories, the metals sitting in vaults ready for use, are just dwindling rapidly.
Yeah.
You simply can't run a deficit that large year after year without running down what's in storage. That's what translates to the tightening physical availability we're hearing about.
Okay, so let's talk about the demand side, because this is where the story has really shifted, right? Silver isn't just money anymore.
Not at all. It's an indispensable industrial commodity.
What percentage of demand is industrial now?
It's over 50% now. Over half of all silver demand is purely industrial.
Meaning it gets used up, it's consumed.
Consumed and destroyed, unlike a bar or a coin. And the number one driver, hands down, is the green energy transition, specifically solar panels.
Photovoltaic use, how big is that?
It's forecasted to essentially double by 2030.
Double.
Yeah. So when governments commit to these huge green energy projects, they are, by default, committing to consuming massive amounts of silver. This demand is structural, it's long-term.
And what about the other tech sectors?
Electronics and, of course, electric vehicles, EVs, they're both major consumers.
Right.
Those sectors absorbed record volumes in 2025, and this industrial base is now outpacing traditional demand from jewelry and even investment. The industries are setting the floor for demand.
So demand is just soaring, driven by this global shift.
Yeah.
But why can't the miners just ramp up production? I mean, at $90 an ounce, why isn't supply flooding the market?
The supply side has major entrenched issues. Supply growth is extremely limited, often under 1% a year, even at these prices.
Why so low?
There are three key brakes on growth. First, new projects face serious delays, permitting, environmental regulations.
Sure.
Second, we're seeing declining ore grades globally. Miners have to process way more rock to get the same amount of metal.
And then there's that tricky factor you mentioned, the byproduct dependency. This is where it's so different from gold.
It is the single biggest structural bottleneck. Silver is heavily, heavily dependent on being a byproduct of base metal mining.
We're talking copper, lead, zinc.
Exactly. Most of the world's silver doesn't come from a silver mine. It comes out of a copper mine alongside the copper.
So if the price of copper doesn't justify opening a mine, the silver that's in there it stays in the ground.
It stays in the ground. It never comes to market, regardless of how high the price of silver itself goes. You can't just drill for the silver. This dependency just fundamentally caps the industry's ability to respond.
It really is a perfect storm. You have this exponential industrial demand hitting a structurally capped supply, all layered on top of a massive mathematical ratio imbalance. So let's turn to the analysts. Who are the most outspoken proponents of these triple-digit targets?
Well, we've heard some specific high-profile bullish views. Take Mike Maloney from goldsilver.com. He argues that $300 silver is still feasible.
And what's his reasoning?
He cites that extreme ratio disconnect we talked about, and he draws direct parallels to the massive monetary debasement we saw back in 1980.
What does he mean by that? The debasement in the 1980s?
Well, back then you had huge inflation, a widespread loss of purchasing power for the U.S. dollar.
Right, which drove people to hard assets.
Yeah, exactly. And Maloney and others argue that silver's role is to amplify gold's moves during these crisis periods. So if we are entering a phase of high inflation, combined with these physical shortages,
And then silver has a lot of catching up to do.
an explosive amount of catching up, just like it did in the late 70s.
And are any mainstream institutions talking about triple-digit silver?
We have seen some large institutions align with the triple-digit potential.
Like who?
UBS analysts, for instance. They've projected triple-digit silver, maybe $100 or more, specifically because of green energy and the deficits.
Okay.
And Sprott, a major player in physical metals, also anticipates silver continuing to outperform well into 2026.
So we have outliers suggesting $200, even $300.
Hmm.
And the sources do say that 300 requires mania-like conditions.
They do.
But what's the more, let's say, sober consensus for 2026?
The short-term consensus targets generally start at $100. The mainstream forecasts, though, the ones that prioritize risk management, they tend to cap 2026 somewhere in the $100 to $150 range.
Right. So this raises the important question. The math might point one way, the fundamentals look tight, but markets rarely follow a perfect script.
Never.
What could derail this whole bullish forecast?
That is the essential question. And the number one risk factor is volatility itself.
Just how volatile is silver?
It's notoriously volatile. It has a beta of over 2 times that of gold.
Okay, can you break down what beta means for someone who isn't tracking financial metrics?
Sure. It just means silver amplifies market moves in both directions. So if gold pulls back 10%,
Silver could easily drop 20% or more.
exactly. That high leverage is why its price action feels so extreme. We even saw it in 2025. During a year it gained 148%. It still had pullbacks of over 20%.
Wow.
So when speculative positioning gets too crowded, you risk these sharp, sudden reversals that can wipe out months of gains.
So that's one risk. What about the broader economy? What happens if things slow down?
Economic influences are a major counterargument. Remember, over 50% of demand is industrial.
Right.
So if we see rising interest rates or a major industrial slowdown, a serious recession, that would suppress that critical demand from solar and EVs.
And that would hurt both demand and supply.
Exactly. A drop in copper usage means less base metal mining. It's a double whammy.
And we can't forget the U.S. dollar.
Absolutely not. Historically, a strong U.S. dollar puts consistent downward pressure on commodities. If global monetary policy tightens, the dollar could stay stubbornly strong, and that would make it very difficult for silver to break out.
And finally, what if the ratio just stays where it is? What if the 50-to-1 ratio just persists?
It could. A lot of the mainstream caution centers on that possibility. The inertia of the paper trading markets is immense, and they could keep challenging the fundamental rebalancing thesis, even with emptying vaults.
Before we wrap up, let's just ground this in a bit of history. Why does silver tend to set up for these dramatic catch-up phases?
It's because of the leverage it provides during inflationary periods. It just moves so dramatically.
Right.
I mean, look at the 1970s and 80s rally. Silver went up 30 times, from $1.50 to $50. Post-2008, it tripled to $50 again. It has this long history of lagging gold and then setting up for these huge, volatile catch-up phases.
So what does all of this mean for you, the listener? We've gone through the sources, and the key takeaways are pretty clear. The forecasts are based on 3 key pillars coming together right now.
Precisely. Those pillars are, 1, that extreme mathematical divergence between the 50-to-1 market ratio and the 8-to-1 production ratio.
Oh.
2, that mathematical potential is being backed by chronic physical supply deficits, over 200 million ounces a year.
And 3.
And 3, skyrocketing industrial demand that is locked into the green energy transition.
And as an educational takeaway for you, understanding the difference between that market ratio and the production ratio is absolutely critical. That 8-to-1 physical scarcity is what gives the $300 math its potential power.
Exactly. But the models just highlight potentials. The actual outcome is going to hinge entirely on unpredictable macro variables, like interest rates and the dollar.
And we have to reiterate, prices are highly volatile. That high beta means sharp turns up and down are inevitable.
Absolutely.
Agreed. So let's end with the provocative final thought, something for you to mull over based on this structural dependency we uncovered. We mentioned that silver supply is tied closely to base metal mining. It's a byproduct.
That dependency is the core tension.
So think about this. If global recession fears intensify, and that suppresses the mining of base metals like copper and zinc, what happens to the silver deficit?
It's a fascinating question.
Would the supply shortage get even worse, creating an unprecedented squeeze? Or would the drop-off in industrial demand overwhelm that supply shortage first?
That supply versus demand tension, right at the industrial heart of the market, is the core unknown. And it's a key question that will determine whether silver hits $150 or goes all the way to $300.
For listeners who want to dive deeper into the verifiable source data, we'd recommend looking up the annual reports from the Silver Institute, insights from major players like Sprott, or the official USGS mineral data for production figures.
Keep learning and keep questioning those extreme numbers.
Thank you for joining us on this deep dive into the $300 silver forecast. We'll catch you next time.